recently recorded a video explaining or attempting to explain the impact of the higher interest rate assumed by HMRC in calculating the discount values for a discounted gift trust. Effectively, the higher interest rate effectively reduces, that's twice I've said effectively, reduces the value of the retained rights because that higher interest rate is factored into what the effective price for an annuity of the flow of income that you're entitled to under the discounted gift trust would cost. So lower value of retained rights means smaller discount. There is another factor to take into account, however, in relation to that increased interest rate assumed by HMRC, and that is when you get to the 10-yearly valuation point, the so-called periodic charge. Effectively, that higher interest rate will have a downward impact on the value of the fund at that 10-year anniversary. You have to go to the examples in the customs brief of 2213, which sets out the maths. In summary, the HMRC basis calculates the open market value of the gifted element at the 10-year anniversary. So what is the value of the fund at the 10-year anniversary? So you calculate it as, number one, the value of a single premium life insurance with a sum assured equal to the then total investment value of the fund. So what is the trust fund worth at that time, at the 10-year anniversary? And say, what would the value of a single premium life insurance, what will be the cost of that single premium life insurance with a sum assured that will be paid out in the future equal to the total value of the fund at that time, at the point of valuation? And then you need to take account, of course, of the value of the future withdrawals to the date of death. Neither part takes account of any future investment growth. It's the current fund value and the current withdrawals that are used with the new discount rate. So basically, it's really, really important to keep this in mind. So it's a corollary to the fact that the higher interest rate assumed means that the value of the retained right, and thus the value of the gift that you make when you first take out the discounted gift trust, means that the discount will be smaller because the value of the retained rights is smaller. But that higher interest rate will have, as I said, a corollary and therefore beneficial effect, because that higher interest rate will mean that there'll be a greater discount applied to the future, to the future value of the fund, which is going to be its current value projected into the future and then discounted back, taking account of the interest rate assumed. So that means if the interest rate assumed is higher, the present value of that fund that will be received in the future is going to be a lot less than it would have been if the interest rate was smaller. So basically, these higher interest rates mean, number one, a smaller value for the retained rights and thus a smaller discount applied when you effect the discounted gift plan, but it also means that there'll be a smaller value attached to the fund at the valuation point when the periodic charges are made, typically every 10 years.